So I'm going to ask each of you guys to introduce yourself. If somebody's not here, we're just going to skip. Okay, so we're going to get started with Tiffany. Thank you so much.
Thank you, Guy. Good afternoon, everyone. As Guy said, my name's Tiffany Phillips. I am a lender, a mortgage lender with Bremer Bank. I've been in financial services for a little bit over 20 years now. It's important for me that individuals that look like me get into homes. So I am here today to educate you all on the possibility of home ownership and what that looks like from a financial and lending perspective. Thanks for having me.
Thank you, Tiffany. So I haven't seen Scott yet. I don't know if he joined us, but if he's not here, we can move on to Charles. Charles, can you introduce yourself, please?
Hello, I'm Charles Osugo, Kenyan American. I've done some credit score webinars with Minnesota Africans United, and I work with Scott Miller, and we are excited to be your commercial agents on finding that cultural center. I've been in real estate since January 8th of last year, and I've been on commercial real estate since November 2nd of last year. Thank you, Larry, for introducing me to Basil, and I look forward to helping the Cultural Center come to be a great reality.
Thank you, Charles. I can see that Scott Miller joined us. Scott, I know I'm taking you too short, but if you want to introduce yourself real quick, open up your mic and go ahead.
Um, Sorry about that. I'm just not a geek yet, and I'm getting there very quickly. But thank you very much for inviting us to your meeting today. And um, great. So I don't know if how many folks do we have on here? About a half a dozen.
31.
Oh, wow. So a big crowd. Okay, great. Yeah, I don't know what you want out of me, but I guess I'll probably talk a little bit later more on your desire to get a community center. That's where I kind of got brought in from Larry Mahoney. Guy, it's nice to see you again. Perfect. So I'm sorry for being a little bit late, but I think you were doing residential home buying first. So
Yes, we will. Yeah,
okay.
right now you're just introducing yourself, and we'll get to
I'm
that.
sorry I didn't hear that.
You're just introducing yourself for now, so we'll get to your presentation later.
Yeah, and I could
Okay.
do a little more elaborate on my background and why
Yep.
hopefully we can help you. All right.
Great. Thank you. So we'll move on to the next person on the call, Basil. Basil, if you can hear me, just a quick
Yes,
presentation for
sorry, my
everyone.
name is Basil
Yep.
Ajuo. I'm the Chief Executive Officer of Minnesota Africans United. Minnesota Africans United is a coalition that brings together all the African communities here in Minnesota to work for a common purpose. And I'll leave it as that.
Thank you. Clark is not here, but I think we can move on to Larry. Larry, can you open up your mic?
Yes, I am Larry Mahoney, and I'm a realtor with eXp Realty. I've been involved with Minnesota Africans United for a number of years now, and I'm very excited to help members and associates of MAU to find houses and to move into houses.
Thank you so much, Larry. So last person we have on the list is Bernard Yamoa. Bernard, can you open up your mic and introduce yourself, please?
Yes, my name is Bernard Yamoa. I run a tax preparation and accounting agency, and currently helping put the books together. So that's the sort of stuff we do here.
Thank you very much. So want to appreciate everyone' attention, and now I want to open the floor to Tiffany for a presentation. I know that It's going to be intense. I've seen the information before, but please pay attention to what Tiffany is about to deliver to you guys. So, Tiffany, do you want people to ask questions as you go, or you want to get to the Q&A session before people can ask questions?
I think it may be best to wait to the end. But if someone has a burning question that they don't want to forget, feel free to bring it up when I teach this in the classroom format. People ask questions throughout, so we can
Great.
take it as the guests prefer. That's fine.
Perfect. Perfect. So, Miller, after Tiffany's done, it'll be your turn.
Awesome. Thanks
Okay.
again, Guy, for inviting me and having me. Again, good afternoon, you all. My goal here is to educate you all on the possibility of homeownership. I have a trimmed down version to my traditional homebuyer education agenda. And the key goal is to help you all understand what we look for from the buyer as it relates to getting you qualified to purchase a home. As you can imagine, a few $100,000 is a lot of money for a bank to loan an individual. So we want to make sure that the individual has strong credit, they have an ability to repay the loan, and they have funds available to help them make that purchase. So my screen is coming up now. You'll be able to see the agenda. So, what I'll cover are financing options that are available to you, down payment assistance programs that you can use to help you get into a home sooner rather than later. One of the key components we use to get you qualified is to calculate your debt to income. So, we're going to look at your income and look at your debts and see what's affordable. So, just think of that as affordability. And then I'm going to wrap my presentation up with the importance of keeping your picture, because once you start the process with the lender and we get you pre-qualified, it's important that you not change the components that we use to qualify you. So when we look to get you qualified, we're going to look at three things, and they all start with the letter C. The first C is credit. We're going to make sure you have a decent credit history. It doesn't have to be excellent. We're typically looking for credit scores in the mid 600 range. And when I talk about credit scores, I'm talking about them from the space of using down payments assistance. Most of my clients use programs that will loan them money, most times at 0% interest. And it's a second loan called down payment assistance to help you with the 3% down or 3.5% down that you need, and the closing costs that are applicable to it. So the first thing is going to be credit. Again, mid 600s. And then we're going to look at capacity. That's your capacity to afford the payment or affordability. And again, I'm going to go over the calculation that we use to do that. And then that third C is capital. Capital is how much assets do you have to make the transaction happen? I'll be able to add down payment assistance to help with reducing the capital that you need, but then we also need to ensure that you have money of your own. So I am going to start my slideshow here, just a moment. And I have three screens. So I'm looking over to the left. That's because I have another screen that the presentation's on, but I'm going to move it over here in just a moment. Just give me a second. Okay, so the agenda again is up. The next slide here, sorry, once it moves on, are the types of financing. So you as an individual, when you purchase a home, you'll look to get a loan. And when you buy a home, you will use one of these loan types. The most common is conventional. It requires you to put 3% down. So if you buy a house for $200,000, you'd be required to put a minimum down of $6,000. Now that $6,000 can come from you, or it can come from a down payment assistance program that I'll talk about on the next slide, or if you have access to a gift from a relative, it can come from those funds as well. So conventional financing is the most common type of financing used. If an individual for some reason doesn't qualify for conventional financing, maybe they've had some credit hiccups in the past with some late payments within the past few years, or maybe a collection account, then we'll need to look at a government-backed type loan called FHA. FHA, the down payment is similar. It requires 3.5% down, but the same thing. It doesn't need to all come from you. We can add money from a down payment assistance program. The next form of financing you see there is rural development. What's special about that type of loan is it does not require a down payment. Where I said conventional requires 3% down and FHA requires 3.5. Rural development does not require you put anything down, meaning your first mortgage loan can be 100% of the purchase price. The caveat, though, with rural development is you have to buy a home, as I like to call it, where the cows live. So you're going to live in a more agricultural area and it's address specific. So as a lender, I would have to look at the address you're looking to buy to see if that address qualifies for a rural development loan. Again, you would be living near farmers, nowhere in the metro. Most of the 11 county area isn't rural development, but you may find some pockets like Farmington, Minnesota, in Dakota County. You could find some, or even a little bit past Maple Grove on the west end. So there is some areas, but rural development is a more specialized type of loan. The next loan option you see there is VA. That's for those who've been members of the military, and they can take advantage of a veteran affairs loan that requires, like rural development, zero down. The last option that you see there is called a portfolio loan. Those loans vary depending on what bank offers them because the banks that offer them have designed the loans. When I talk about the other four options, those rules are set by the investors that offer those loans or the government agencies that offer those loans. So the bank has no control over the minimum amount you're required to put down for a conventional loan or the minimum amount you're required to put down for FHA because those loan types are already determined by other entities. But the loans that the banks have, they created them themselves. So we have an affordable housing loan here at Bremer. It's called Gateway. It's similar to a conventional loan in that you only have to put 3% down, and we're looking for a credit score of about 640. The key difference is we do not charge private mortgage insurance. That may be a new term for you. Private mortgage insurance, it's an insurance that does nothing for you. It protects us, the bank, in the event that your loan goes into default. So we do not charge you private mortgage insurance on that loan, even though you're not putting 20% down. So those other loan types that I went over, if you're not putting 20% down as your minimum down payment, we will add private mortgage insurance to the loan type. So that's a little overview of the 5 loan options that are available. You will complete one application once you're ready to start the process of buying a home. Typically, as lenders, we're going to look at a conventional loan first. And if for some reason we're unable to use a conventional loan, then we'll look at those other loan types. Key differences, I'm going to give some key differences between conventional and FHA because most people will use those types of loans. The key differences are how I talked about the down payment, right? One requires 3% down, the other one requires 3.5% down. Another key difference is with private mortgage insurance. Conventional will allow you to stop paying that private mortgage insurance that does nothing for you. Conventional will allow you to stop paying that once you get to 20% equity in your home. That's typically after you've owned your home about 8 years, you will have 20% equity in the house, and that's when your payment will go down because you'll stop paying that private mortgage insurance premium. And I have a payment example a little bit later on in my presentation that'll show how that payment is broken out. FHA is different from conventional in that you will never stop paying for private mortgage insurance. So as long as you have that FHA loan, that private mortgage insurance will be a part of your payment. Another key difference is how we're required to treat student loans. A lot of people still have student loans, and we have to calculate that as a debt that you're responsible for when we look to determine how much home we can qualify you for. Now, conventional will allow us to have some more favorable calculations. Let's say your student loan payment is zero. And your student loan payment is not zero because of the COVID pandemic. So I cannot count a $0 payment because your payment is zero due to COVID. On the flip side, if you have a $0 student loan payment because you're on an income driven repayment plan, then I can count that payment as zero. FHA never allows us to use a $0 payment. They want to make sure at all points you are able to afford a student loan payment. So they will make us use or estimate a 0.5% of your student loan balance as your payment. As an example, if you owe $50,000 in your student loans, for your student loans, a 0.5% of that is $250. So I will have to count your student loan payment as $250 if you're not making a payment. Or if you are making a payment and that payment is $100, then I get to count $100. So those are some key differences with between conventional and FHA. And I point those out because most people use those two products to purchase a home. Another key difference is how they treat credit hiccups. So, conventional, they're sticklers when it comes to credit hiccups. So, if you've had any credit hiccups in the past 3 years or so, we may not be able to use conventional financing. A credit hiccup would be a late payment, it would be a charge off, a collection. You could, there's a possibility you don't have any hiccups in your credit, but you have a really thin credit profile, meaning you haven't had many credit accounts, then we may have to use an FHA loan in that sense as well. Now, another key difference between them is I talked about private mortgage insurance, but FHA charges a fee. And in my example that outlines a breakdown of the payment, you'll see the fee that FHA charges, which is 1.75% of the loan amount. So, whatever your loan amount is, they will charge 1.75%. You don't have to pay that up front. We can add it to your loan amount. So, I'll show you an example of that. So your loan officer will help you understand which of these mortgage types makes most sense for you based on your situation. The other thing that differs between them is how much of your income you can use to pay your debts and us still determine that to be affordable for you. And I have some examples of that. So just so you know, conventional financing, the first type, will only allow us typically for a first time home buyer for you to use no more than 45% of your gross monthly income to pay all of your debts. So that includes whatever this new mortgage payment is and whatever other debts you have on your credit report. We will not include stuff like your T-Mobile bill or your health insurance or what you pay for like household items. We don't include anything like that. We're including what's on your credit report as your monthly payment in addition to any tax payments you're responsible for. Let's say in 2021, you owed the IRS $1,200 and you're paying $50 a month until that's paid off. We'll have to include that as debt. Or if you are responsible for child support or alimony, we also have to include those as debts. So conventional financing will stop us at 45%. And I'm going to get again show you a calculation of that in just a few minutes. But FHA sometimes will allow us to go up to 50% of your gross monthly income. And again, we're calculating income. Gross means before taxes or anything is taken out. And so these are the types of loans. That's a little bit about what we're going to look for from a credit perspective. Um, and then the next slide is going to talk about some down payment assistance that's available for an individual to help them with that 3% down or 3.5% down that they may need. Before I move on, I would like to pause for questions. Are there any questions regarding the types of financing that are available and the things we're going to look for to have you qualify for it?
Tiffany, I have a quick question. I think after this brief presentation, which is awesome, I have a concern. Let's say I have a FHA loan right now. Is there still a possibility for me to convert that loan to conventional?
Yes, an individual has an opportunity. You can refinance. So that would be a refinance. You would get a new loan to then pay off your old loan. The key, though, with refinance is you will pay closing costs again. So the closing costs you paid as part of your purchase. So for title work, for appraisal and all that stuff, you will pay those fees again. But yes, you have the opportunity to refinance that home to get out of that FHA loan, potentially get rid of that private mortgage insurance portion of the payment. Now isn't the best time necessarily to refinance because rates have increased. So it's going to depend on what your interest rate is if it makes sense for you to refinance. But if you're going to get rid of a private mortgage insurance premium, even though you may pay a little bit higher interest, it may make sense. So that's something I can help an individual understand if it makes sense financially for them to refinance based on what their home is worth and what that new loan amount would be. Great
Thank
question.
you. Yep. Thank you.
You're welcome.
There is a
Uh,
hands up, Madam Dewey.
Libby.
I have a question. So if you already have a home and you want to buy a second home, so let's say that the first home you had a FHA loan. So what is the possibility to have a second home, like you want to use it for something else, for rented? So how the process work?
So the process is the same. You would still use one of these loan types to purchase a home, but if you're using the home as an investment property, it looks different than if you're purchasing a home for yourself. It looks different based on down payment required. So conventional financing, when I said 3% down, that's for a first-time home buyer, meaning they have not had ownership interest in a home in the past 3 years. If an individual who has previously owned a home is looking to purchase, let's say you were looking to purchase a different primary home and you were going to sell your old home, then for conventional, you as an existing homeowner would need to put 5% down for that conventional purchase of that other property. But that 5% is only if this new property is going to be your primary home. If you're going to use that new property as an investment, so you purchase it and you tell me, I'm going to rent this property out that I'm purchasing, you're going to be required to put 15% down. So when I talk 15, 1 5, and
Oh,
that's
one
for a
five.
single
Okay.
family home. Yep. So it's going to, when I speak about this, I'm speaking about a first time home buyer for the most part, purchasing a home when we're looking at how much you're required to put down because those items change depending on if it's your first home, if you're using the home as an investment property or your primary residence. Great question. I'm happy you asked that. Other questions before I move on to down payment assistance? Okay,
I think that's all we have.
perfect.
Actually, I have a quick question.
There's one. There's one. Ange, go ahead.
Sure. So, what would be the benefit between a refinance versus a second mortgage?
Well, what are you looking to accomplish?
A refinance with, I guess, taking some money out.
So it's going to depend on what you're looking to use the funds for and how you plan to use it. I met with an individual yesterday. Their home is completely paid off. They were looking to take some equity out to make home improvements because they plan on selling the home in 5 years. They were thinking of about $100,000 to of equity to take out. And they were going to just get a new mortgage to finance those improvements. After talking to them about the purpose of their loan and how they intended to use it, I suggested that they get a home equity line of credit. It made more sense for them to get a home equity line of credit instead of doing the traditional mortgage to take cash out because we have a home equity line of credit option with no closing costs. So that individual would be able to get a line of credit up to $100,000. It would cost them nothing to get that line of credit, and they would be able to use those funds as they need them versus me doing a first mortgage loan, giving them $100,000 upfront. They're paying interest on those funds right away, and they're not even using the funds right now because the contract work hasn't been done. So it's going to depend on what you're using those funds for. And for just based on the interest of time and the key purpose of the presentation, my contact information is going to be on the last slide. I think we should reserve refinance questions, questions about second home purchases or investment home purchases as offline questions, because we want to make sure the individuals who are interested in purchasing a home for the first time understand what that process is and looks like for them. And those who have already purchased a home and they have more specialized questions, we can take those offline.
I think that's a good
Very well.
idea.
Thank you.
Perfect. Thank you. So on your screen, you see the outline of a down payment assistance program that's offered by the state of Minnesota. Most my clients use this program. They use this program because the state of Minnesota's housing finance agency never runs out of money. So they always have funds available to fund this program. In addition to that, you can buy a home anywhere in the state of Minnesota and use this program. Whereas there are other community-based programs or city-based or county-based programs where you have to find a home in that city in order to use the program. So I'm going to go through the requirements for it. An individual would apply for their first loan, one of the loans I explained on the previous slide, and I would automatically add these funds to their application based on if they meet the income limit. We don't have to worry about credit score because they have to qualify for a loan on the front side, one of the first loans I talked about, in order to even qualify for this program. So that's where I said we're looking for credit scores in the mid 600s. It's typically 640 or 650 that we're looking for. And the way we determine what credit score to use when you start this process, we're going to pull your credit. We're going to get your credit score from each of the credit bureaus. We're going to throw out whichever score is the highest because we get 3 scores. We're going to throw out whichever score is the highest. We throw out whichever score is the lowest, and we keep the middle score. So if you have a 680, a 700, and a 720, I'm going to throw out your highest of 720, throw out your lowest of 680, and keep that middle of 700. So again, to use this program, we need a 640 or 650. The next key factor is you meet the income guideline. So the income here on the first bullet is maximum income, and it's based on your household size. So if you're like me and you have a 2-person household, the limit is 76,000. If you have a 3-person household, the income limit is 85,000. 4-person household, 95,000, and it goes up to $117,000, and that's up to 7 people, 7-person or more. That household income can be up to 117,000. Now, when they count income, they are counting the income of whoever is on the loan and who they're married to. So in my situation, I have a 2-person household. It's myself and a 21-year-old son. He works when he's not in school, but they're not going to count his income when we look at calculating income because we're not married and he won't be on the loan. So that's the income. That's the first thing. The second thing is they want to make sure the funds are available for individuals that need it. So the way they determine that is we're going to do an asset test. As part of the process, you're going to give me your bank statements so I know how much money you have. And I have to make sure that after you bring whatever amount you need to bring to the transaction, I have to make sure that you will not have more than $12,000 or 8 months of your payment. So that PITI just means your full payment. And I'm going to show you a breakdown of it in just a moment. So we're going to make sure, let's say you give me bank statements where you have $16,000 in it, and I tell you that you need $2,000 to close your transaction. So after closing, you're going to have $14,000. Easy math, that's higher than what you can have, which is $12,000. So we would make you put some extra towards the transaction to make sure you didn't have over $12,000 after the loan was done. The third criteria is you have to put at least $1,000 of your own money into the transaction. So as long as you can meet those criteria, I can add these funds to your account to help you close the transaction. And the funds are up to $12,500. That $12,500, if you meet the criteria on the screen, it's at 0% interest. You will pay it back when you sell your home, refinance your home, or pay your home off. So $12,500 at 0% interest. If you meet a couple additional pieces of criteria, I can give you 15,000 instead of 12,500. You must meet two of the four criteria on your screen. One of them is be a single parent with a dependent. The second is you have a household size of 4 or more. The third is a member of your household is disabled. And the fourth criteria is you're paying more than 28% of your gross monthly income for your housing payment. That's what it means when it says front end ratio of 28% or higher. That just means your mortgage payment is more than 28% of your income. So this is a great down payment assistance program that people can take advantage of. And let's say your household income is over what you see on the screen based on your household size. Then they have another loan option that you can take advantage of. It's for people whose income is up to $156,000. The other caveat I should add is for this program, you must be a first-time home buyer. Their other program, you can be an existing homeowner that you've owned a home before. Your income can be as high as $156,000, and they will loan you up to $17,000. The key difference, though, with that program is it's not deferred. So you will start paying that money back right away, and it'll be stretched out over a 10-year period. So again, though, that loan is for individuals who may make more income than what you see on the screen, or they're an individual who have had ownership interest in a home in the past 3 years. So most of my clients use this program. There are other programs that are available for down payment assistance. Sometimes they can be layered, so an individual could potentially use this program and another down payment assistance program to make the home ownership more affordable for them. Questions on this program? Okay.
Yes,
And again, I was just going to add there isn't a second application for this. So I would automatically add these funds to the loan. So let's say once I did your pre-approval and it looks like you can buy a home for $250,000, and based on 3% down and your closing costs, it looked like you need $14,000. I can add 12,500 from this program, so then you'd potentially need 1,500. So I would automatically add these funds with you not needing to do anything other than confirm you're interested in using it. And now I'll pause for that question.
Yeah, there are two people here. I think the first one is Max, and the second person here is Binny.
Okay,
So
go ahead, Max.
Yeah. So if you already buy your first home on FHA and put your own money down as a down payment, are you still eligible for this program?
Do you still own that home?
Yes.
This program, this startup program, is for first-time home buyers. So it's individuals who have never owned a home, or they have not had ownership interest in a home in the past 3 years. So an existing homeowner, an individual that currently owns a home, would not use this program. They would use that other program I explained where they would borrow you up to $17,000, but you would start making that payment over a 10-year period. The loan is not deferred until you sell your home. It's also not at 0% interest. The interest rate on that down payment assistance loan matches whatever your interest rate on your mortgage is. Right now, it's like, let's say 5.25%. So you would pay 5.25% on your first mortgage, the conventional FHA or VA loan that I explained on the previous slide. And then your down payment assistance loan of 17,000 would also be at 5.25%, amortized over a 10-year period. So that's a different program than the one that's outlined on your screen. But yes, there are funds available for an individual that has owned a home already.
Okay. Even if it's less than 1 year,
Correct.
you're no more qualified because you're already a homeowner. Okay.
Correct. Yep. You can just use a different program.
Sounds good. Thank you.
You're welcome. Benny, what question do you have?
Oh yeah, actually, I think you kind of touched on the question. It was going to be on interest rate. So when you take out that loan for down payment system, I guess does it come with interest rate on it as well? That was the question I was going to ask, but I think you cannot touch on it.
Yep. So it's going to depend on which of the programs you use. If you can qualify for this program on your screen because you've never owned a home before and you are under the income limit that you see outlined on that first bullet, then you can use this one and there is no interest on the down payment assistance loan. If you are an existing homeowner and you're looking to buy another home, and the other thing I should say is you have to live in these homes in order to use down payment assistance. So whether this program or the other program for existing homeowners, you cannot take advantage of these programs without it being your primary residence. So you would be purchasing a home that is your primary residence. So that's what you'll want to tell your loan officer. Yes, this will be my primary residence, and maybe you're going to sell the other home that you own, but you would be using that other program, not this one that's outlined.
Okay.
So we have a last person here. I think for time purpose, if we can limit this intervention, maybe 3 person per
Yep.
questions, that would be great.
Perfect.
Yo, Usman.
Yes, hi Stephanie. Tiffany.
Hi.
My name is Magnificent Joe, and I'm actually a realtor. So I'm glad to see you here on the call.
Yes,
I've
nice
been
to meet you.
Yeah, so I've been looking for actually good lenders. So, and then I really like what you share with us here. So quickly here, one question I have: can you share with us how long will it take for someone to get approved when they get a hold of you? And then that's one question. And also, from when they find a home, how soon can you get them into their home once they
Great
find a
questions. So the pre-approval process, once an individual completes an online application and provide the requested documents, that typically takes 1 to 2 business days for me to get them pre-approved. So that gives me time to add it to my task list and make sure it's done. I review it, and then I'll generally meet with the consumer within 1 to 2 business days. So we'll schedule some time to go over numbers in detail. Then they'll work with Larry or someone from the EXP team, and they'll help you find a home. Once you have an accepted purchase agreement and you're saying you're moving forward so that inspection is done, then I need 30 days to close that loan. So 30 days from when I'm given the go ahead to move forward with the purchase, which is typically after inspection. Great
Thank
questions. You're welcome. Thank you.
Yeah, I think we can move on now. Thank you.
Awesome. So I talked about the key things we look for are credit, capacity, and capital. Are your credit good? Can you afford the payment? And do you have the money needed? So on your screen is what you see are rate calculations. We have to calculate how much of your income is being used to make that new mortgage payment. And then once we add in the debt that's on your credit report that you're responsible for, how much of the income are you using as a whole? Again, we try and limit your total debt to income ratio to 45%. Sometimes we can go up to 50% if you're using an FHA loan. So on your screen, we have an individual that works 40 hours a week. They make $20 an hour. I'm going to take 40 times 20 times 52 for 52 weeks in a year, and I get their annual income of $41,600. I then need to divide that by 12 because your bills are due monthly. I care about your monthly income. So when I divide that by 12, this individual's gross monthly income is $3,466. I have estimated a payment of $1,000. So I'm going to take their estimated mortgage payment divided by their gross monthly income. And in this instance, it's 1,000 divided by 3,466. And I get a housing ratio, or from the previous slide, a front end ratio of 29%. This individual is meeting one of the 2 criteria from the previous slide to get that extra $3,500. So then the next step that I use to truly qualify is add the additional items you're responsible for, whether it's something coming from your credit, child support, alimony, some past tax bills. In this example, they have other debt that totals 300. I'm adding their credit card payment, their car payment, and their student loans. So now I take the $1,000 housing payment, I add it to the other debts that I found on their credit report. And again, I'm using the minimum monthly payment for those accounts. The total now is 1,300 for debt. I then take their total debt now, divided by their income of 3,466, and I get a debt to income ratio in this example of 37.5%. That's a great debt to income ratio, and that's actually a good housing ratio. Ideally, you want about a third of your income to go towards your mortgage payment, and about 45%, no more, should be your debt to income once we add in all the debts. As in this example, theirs is 37.5. So this is what we use to calculate how much home you qualify for. So we may need to lower the purchase price of the house. You may start your application at 300,000 based on what you're seeing out in the market, and then based on your income and your debts, I may need to bring that down to 225, 250. But then I'll show you what more you can qualify for if you didn't have some of the other debts you have. So I'll help you see what it could look like if you were to get rid of some of your debt, if it seems you want to qualify for more home than it looks like you can afford. So this is that second C we look at, capacity. The next item that we're going to look at is how we break out a payment. So we determined that the payment is affordable. On the previous slide, I showed you how we calculate that. This example shows how we break out a full payment. Your full mortgage payment is going to include principal and interest. So that pays the bank back for the loan that you take out. And then it's also going to include your property taxes and your homeowner's insurance. So in this example, we have a purchase price of 175,000. The individual is putting 3.5% down as required by FHA. The interest rate is 4.25%. Unfortunately, rates have been increasing over the past 2 months, so that's closer to 5.25, 5.5% right now. Before this example is 4.25. Now, the FHA rate is the rate at which we charge you interest on the loan. The APR is what the true cost of the loan is, and that includes whatever fees the bank is charging. So there's some fees up front for getting the loan done. They're not paid before you're done, they're paid at closing. But we have to show you what the true cost of it is, although your interest rate will be whatever your interest rate is. So in this example, if an individual puts $175,000 down, I mean, 3.5% down on their $175,000 purchase, their loan amount should be $168,875. But remember, I said FHA charges a fee of 1.75% of your loan amount. So we're going to add that to the loan. So now their loan amount is $171,830. To the right, you have that payment breakdown, the principal and interest on this 171,830 over a 30-year period at the interest rate of 4.25%. The principal and interest portion of the payment is 845 and 30 cents. That portion of your payment will never change for the life of the loan because it's based on your interest rate and how much you originally borrowed. Then we add your private mortgage insurance. Again, that does nothing for you. It protects the bank in the event that your loan goes into default, but it is added to your loan if you're not putting 20% down. The other components of the payment is we're estimating 125 for homeowners insurance and about 250 for property taxes. So a full payment in this purchase example is $1,339. So we would then look to make sure you as an individual, based on your gross monthly income, you can afford this payment in addition to whatever you're responsible for on your credit report without using more than about 45% of your gross monthly income. So that's how we determine capacity. Can you afford the payment? So that's the payment breakdown, a potential payment breakdown. Yours will look different if your purchase price isn't 175 and the other components of this example are different. I want to wrap my presentation up with the importance of keeping your picture. And before I go over these things, I will add that as a part of your home buying team, there's a group of professionals that are going to help you through the process. You have your lender, that's me. I have the responsibility of doing a really good job reviewing your credit, making sure your income is stable. And in that sense, we're generally looking for a consistent 2-year work history in order to use that income to qualify you. So you have me as your loan officer, making sure you're qualified to make the purchase and then approving you to go out shopping. And then I'll then free you up, essentially approve you to go shopping with someone like Larry. Larry's going to talk about the process of finding a home and what that looks like to get you to the closing table. But then you have individuals like appraisers. They're going to come in and make sure you're not overpaying for the house, that you're paying exactly what the home is worth. You have title professionals. So just understand there's a group of professionals whose responsibility it is to ensure this transaction goes well from the beginning to the closing table. And we do the best work to ensure this happens with minimal hiccups. But it's also important for you as the consumer to keep your picture. Once you start this process with me, typically your pre-approval is good for 120 days because that's how long your credit report is good for. So if you start the process and then you close on that house within 120 days, I will not need to repull your credit. But if you don't close on your house, I may need to repull your credit. That's why one of the components of keeping your picture is to not get new debts or have your credit pulled. That ensures that your picture doesn't change should I need to repull it. So keeping your picture means not changing the components that I use to approve you. I determine what income I can use to qualify you, so don't quit or change your job. I received your bank statements to understand the assets that you have available to you. So regarding your bank statements, you want to try and avoid non-payroll related deposits. It just makes the process a little bit more complicated for you. You then have to document more things and help us understand where those deposits come from, especially if you're using a down payment assistance program. You also want to make sure you're not just going into your account and withdrawing $5,000 in cash, especially if you're using a down payment assistance program, because it'll look like you were trying to skirt that asset test that I talked about on the down payment assistance screen. And then it goes without saying, you don't want to use the money that I told you you need for the transaction. So these are all components of keeping your picture. The other thing I use to qualify an individual is what debts are they responsible for. So you don't want to go get more debt because if I find out about that additional debt before you close, now I may not be able to approve you for what you originally were approved for because you went out and got more debt that you're now responsible for paying. I already indicated that your credit report is good for 120 days. And once you start this process, ideally, you don't want to pull your credit again. So once I've met with you, gotten your application, approved you to go shopping, and you're ready to start shopping, then you'll start working with an agent to find the home of your dreams, and we'll make sure you get into it. Here is my contact information. Email is preferred, but both my office number and my cell phone number is listed. I work from home, but I also work out of our Brooklyn Center branch. I have an office there. I'm generally there on Tuesdays, can also be there other days of the week. So don't hesitate to reach out with additional questions. I know we answered most of them throughout the presentation, and in the interest of time, I know we have other presenters coming on. We may want to hold remaining questions for offline, and you all can reach me directly at the contact information on the screen.
Thank you, Stephanie. If people can open the mic, we can give Tiffany a round of applause for the great presentation that she did. So, thank you.
Thank you. I appreciate that.
So I see some hands as Tiffany mentioned. If we can hold the questions either offline or waiting for other presenter to go, and then we can ask questions. That would be good. So
thanks again for having me. I appreciate it.
Thank you.
And I'll put my contact information in the chat as well.
Okay. Thank you.
Thank you so much, Tiffany. That was awesome. I think we're going to move on to the next person who is on the call right now. It's Scott Miller. So, Scott, if you want to introduce yourself one more time and then get started, that'll be awesome. So, Scott is going to talk to you about the commercial side of what we're trying to do to acquire the cultural center for CIM-USA. Thank you, Scott. Go ahead.
Oh, thank you. Thank you very much for inviting me again to this meeting. Boy, a tough act to follow there. So my compliments, Tiffany. I think I'll be calling you, even though I only do commercial. That was great. But yeah, we met, about 3-4 weeks, about a month ago. And I do have some, well, let me give my background. I'm born, bred, raised in St. Paul, live out here just south of St. Paul. I've been in the
There's an echo. So if you're not speaking, can you please mute yourself, or if you can mute everybody and Scott?
Yeah, Scott will have to open his mic again.
Okay, I'm open. Fine.
Okay, perfect.
Okay, thank you very much. So my background is construction. I started when I was a young man into painting and got into restoration work in St. Paul. Did small time contracting, small independent business person. I had a partner, and we did a bunch of renovations in the St. Paul area. After that, I kind of got into real estate a little bit for a few years, but I kind of liked the construction world and design and sales and doing remodeling. And through that, I ended up getting my commercial certified building official license. Not that I wanted to be a building official, but it was really building inspector, but it's really good knowledge to have, because I got into working with a gentleman for about 10 years. Unfortunately, just passed away, Herb Margolis, wonderful mentor of mine, doing owner's rep work for commercial construction. So, for example, if you wanted to build a new building, you had no idea what you were doing, you'd want to hire me. So that is kind of a nice advantage. Plus, now I've been a commercial realtor for Keller Williams, KW Commercial, since 2004. So I've kind of got a good grasp on this business, and it's been a good business for me. One thing I've kind of done, and I think one of my young little mentees is on here today, Charles Osugo. I'm kind of really into right now. I have about 8 to 10 interns. Most of them are people of color. I'm really dedicated to that right now, getting them into the commercial real estate world. They don't have to be commercial real estate agents, but there's a huge, you could be a commercial lender, commercial title person, commercial attorney. We're trying to get the young ones, because if we don't get them, the other industries will. So I'm a little bit on a crusade on that, just so you know. So if you know some young'uns that want to get into it, please let me know, okay? I don't have a formal presentation, but I do want to talk to you about the project you have in mind for a cultural center, meeting and events and everything you want to accomplish. I do work in the commercial world, so I have good experience in that field. I've worked with a lot of nonprofits. I've been on a lot of nonprofits boards. I tend to be coming from my mom got that beat into me, you volunteer for things. So I do. So here I am. I'm working with you all on this. The steps you need to take on this are a large task ahead of you. But, just like Tiffany mentioned, your steps going through for residential financing and everything, we're going to parallel that a little bit also. It's a little bit different. Nonprofits have a little more of a difficult time getting financing. I think Bremer, you're with Bremer, correct, Tiffany? Right. Okay. And I know Bremer's excellent on with grants and everything, and I know you're going to be working on that. So to do this, I think you're going to need a committee of people and really don't have more than 4 or 5 to be on your committee to do this report to the large group. Otherwise, nothing gets done. But what you want to do is first, then you got to raise money. That's the most key part here. So typically in nonprofits, thank God they exist, but it's always 5 to 10% of the people pay about 70% of everything. So you got to get that group, your 5, 10, 15% that carry the weight financially. They're your influencers. They're your people that are going to be most dedicated. And I think Guy, you showed me on your list of quite a few people already in that category, and you're very, very lucky to have that. But once you again, meet with a couple lenders, I'm sure Bremer's excellent. There may be a couple others just to interview them. I believe there's now a new bank that just opened up, a Black-owned bank, which is, I think, phenomenal. Maybe something to talk about with them. Again,
could I interrupt? It's
yes, go ahead.
First Independence Bank, Black owned. They had a grand opening on Tuesday. I'd imagine they'd like to help. They also had grant funding through Bremer Bank for their creation.
Correct. So that's why I bring the young ones. They know all those factoids. We got to have them here. They're great. So, but when you do get your loan, more than likely the type of loan you're going to get is what's called recourse. Recourse means potentially you were responsible for the debt. Non-recourse means no, you're not responsible for the debt. Most likely, and most of the nonprofits I've worked with typically have to have several members who step up and do guarantee the loan. And that's what recourse financing is. They want names on the dotted line, just in case something happens. So I think what you want to do, we did go over some ideas about how many people you have. You're at about 90 to 100 members right now, but you're going to have events quite large, up to 300 people. We need a lot of parking. You need some smaller meeting rooms and areas for your group. And there's some good, what I think you almost need to look at is more of an industrial type building or large, one story. We just did find one. I don't know if the Phoenix residents are a nonprofit. We did find them a beautiful building. It was about 22,000 square feet. It was on Plato and Lafayette, by the Lafayette Bridge in St. Paul. Pretty reasonably priced for what industrial buildings are going, and almost would have been perfect for you guys. They bought it a few months ago, sorry, but it's got large space, good level, and it's got huge parking. Their deal is, I think they were about 1.8 million. So for the size building you're looking at, you're probably going to have to budget somewhere between $1.5 to $2 million to accomplish the size building that you have. Banks, again, if you can supplement it with some of the grants, but most likely you'll be 20% down payment. So it gives you a target to reach of how you can do it. You may, who knows, we may run into someone that is benevolent and will do a part, you can finance part of it, and maybe they'll do a small contract for deed on the loan. Contract for deed means the seller actually acts as part of the bank. He's like the bank, and that it's sometimes easier to get money put together. And I think that's where, like Tiffany was talking about, little bundles from here, there, and everywhere, and then all of a sudden you've got a deal put together. So there might be a little funding here, a little funding there. You've got your contributors contributing the funds and committing. The other thing is when you're doing this and you're raising funds, there's two things. Is you want to do that is not on cash. You don't want to do cash donations. You want to trace it. I've been on a lot of nonprofit boards. And I ran the baseball program where I was the baseball commissioner. And what we did was, and unfortunately, a lot of nonprofits have been money stolen from them. So we had a huge tournament, 1,200 people a day. When we counted the money, I had somebody else go in the room with me to count it. So you got to really be safeguards in nonprofits. It can happen to y'all. Make sure you maybe have two signers on the money you're raising, because all of a sudden you're going to have a lot of money you're going to run into in the bank, and you got to be very, very careful of that. So that's why you make sure people are writing checks so you can account for it. You've got receipts for it. You know it's there, and it's a lot safer way to take money. The cash sometimes, is troublesome because it's cash. It's nice, but I think people as members also, you get a tax deduction because you're writing a check to the nonprofit. So when you do that, you actually get a tax deduction. When you have the cash, you can't really prove that you did it. So it really be my recommendation is when you do this, try and get it. Cash, I don't think you really want, but definitely credit cards are okay. Debit cards, I think you could do maybe through the bank. But something that locks in so you have a receipt is really important as you're raising funds. So I've seen a lot of this. I think North High School just had that happen to them. I think $40,000 or $50,000 was stolen from the student fund for scholarships and uniforms. And it can happen really quick. So it's just, I don't want to scare you about that, but all of a sudden when you have, you're buying $1.8 million building, as 20% is $360,000 cash laying around. So again, just be careful of that. Be, very small unit and group that makes the decisions here on what you're going to do. Typically what we do is put together some information for you, maybe go look at a couple buildings, see how that works with a small group. And then once you really get focused on it, we try and tie down that property and have an open house for all the members to come. And then it's also a nice fundraising time to show every member what we're doing and how it is. So those are kind of what we would help you with. I think it might, it depends on how fast you can raise money. I know commercial rates are a little bit, actually, I heard a little less than residential rates right now. So it's kind of interesting. We'll see how that works and how it pans out in the next, time here, 6 months to a year. So that's kind of the information I wanted to share with you today. I know we have quite a few people on here that are going to talk. I can type my information into the chat. If anybody, or maybe 3 quick questions, and then I'll type my information in the chat and anybody can call me after that. Any questions?
Thank you, Scott.
Thanks.
I think I see Beanie's hands. Go ahead, Beanie.
I don't know what I'm doing. First, asking all kind of questions. You mentioned fundraising as a source of income to help us leverage money for that building.
Right.
That has been something we've been thinking about in the executive board. Do you have some ideas of what things we can maybe do as fundraising to get those kind of money? And also, do you have some suggestions or tips on how we can touch some of these key people in the top 5%?
Well, do you have a lot of youth, young people in your community? Do you have a lot of young people?
Yes,
it would help.
Yes.
I mean, they can go do a car wash during the summer. They can raise funds that way. You could have a fundraiser where you are now. You can, just have an entertainment night and a fundraiser for folks. You bring in maybe a speaker. I don't know. So, there's tons and tons of ways to do fundraising. You can bring in a professional fundraiser. They are spendy. They typically they take 10%. So, but maybe you have people in your group that have that ability to go out in the community. And again, on this type of a thing, you're really going to see like 10 to 20% of the members are the ones carrying the weight, and that's your fundraisers, your biggest. But everybody, all the social service agencies I've seen are doing some type of fundraising. The Phoenix residents I met, they have an annual golf tournament that comes up. You may host some type of an event. Maybe it's not golf. Maybe it's, I'm not even going to say pickleball because I don't even know how that game works yet. But I'm sure someday I guess I will when I'm old and have gray hair. But yeah, I think if you put your brains together and maybe you have a fundraising committee and they come up with some ideas and challenges and working together, or maybe have somebody that will match grants. Match how much you raise, maybe like the NPR does on the radio, because they, that's how they get people. They go on the radio and start talking and please join as a member. So I think if I don't do a lot of fundraising, but I've been to a lot of fundraisers and, sometimes have silent auction where you get donations from business people as part of the event and you auction off something to something, I don't know. Maybe Bremer Bank's going to give away money, free money. I mean, that would be really nice. She didn't laugh. Oh, well. So I think, does that help you with a few ideas, Denny?
Yes, that helps.
Okay, perfect. All right. Somebody types fast. All right.
I think that's all the hands I see here, and I see that Gage's taking notes also here.
Max has a question.
So there's a Max, go ahead.
Scott, we didn't talk about foreclosure buildings. So because we, as a first time looking for building for our community,
yes,
we don't really need a fancy one. We want something would work, even if there is couple stuff to do. So can you talk a little bit about that too? Because I'm sure if we will find a foreclosure building, it could cost like $500,000 or I don't know, something like that. That's my thought. Yeah.
Unfortunately, at this time, there are zero foreclosure buildings. Unless we look at potentially some apartment office buildings. And they would take some general remodeling because you want big open space. If you need a space and you're going to have, 300 people in a large event room, an office building gets very tough to modify at that point. Right now, the office buildings have come back. Industrial buildings are outrageously priced. Your multifamily is outrageously priced. Single family homes are outrageously priced. So we're going to see a little bit of a dip here. I think we all know it's going to come back down to earth on pricing. We certainly can look at that at the time, but I tell people it's called the market of the moment. At this moment, there's no foreclosures on the market that I know of, other than maybe some hotels. And I think that's not going to work out for you either to buy a small hotel. But there are occasional event centers that come up, but they're not at a discount right now. I think right now you're going to see residential prices probably go down and decline over the next year to 2 years, and I do believe then commercial about a year after that you'll start seeing declining values. So I don't think it's sustainable, but that's my crystal ball. But we certainly can look at anything, but it depends when you're ready.
Yep.
You have to have the resources then on something like that to jump on it. Like it's on the market, let's go see it today. You can't spend 2 days or 3 days with committees back and forth or talking to everybody. And that's why I said, you really got to get down to a real small committee. Even 3 would be better if you can do it.
Yep.
So does that help you?
Yeah.
Okay.
Thank you.
Well, we'll look at anything, Max.
Yeah.
Thank you, Scott. And if people can open their microphone and give Scott a round of applause, that would be great.
Oh, thank you.
Thank you.
Thank you. So, our next speaker here, Guy.
No, I think we have only Scott and Tiffany. So
Okay.
we still have 10 more minutes for questions or suggestions from everyone. So I think we have 10 more minutes before we close.
I like to add a comment. There was a question asked about ways to raise money. I think raffles are a great way to raise money. You may purchase something, say you purchase a trip. You may purchase a trip for $1,500. You raffle the trip off to community members for $25, $50 a ticket. You don't know how many tickets you'll sell. You may sell 200, 300, 500 tickets, but you'll make way more money than you paid on the trip. So look at doing things like raffling things of value that people want, that there'll be a lot of interest in, and you can use things like that to raise money. I know someone that raffled a car. The car was worth like 12 grand. They sold raffle tickets for $100, sold 300 raffle tickets. They got $30,000 for a car that they paid 12,000 for. So just ideas like that, raffles would be a great way to raise some money.
Thank you, Tiffany. I see Max raising his hand again. Max has a lot of questions today.
Yeah, I'm turning to Tiffany. Tiffany, do you have a program for the building we're looking for the down payment?
So I do not work in commercial lending. I only work in residential lending. So for an individual to purchase a 1 to 4 unit residential property. So I connected Guy with Jackie. She's one of our business banking representatives. She couldn't be here today on the call, but Guy does have the information on the process about getting financing. When we talk about additional funds, the Otto Bremer Foundation provides grants to nonprofits in the communities that we serve. We generally provide $30 to $50 million in grants every year to nonprofits. So if you have individuals within your community that are familiar with grant writing, or you hire a grant writer to write a grant for you all, and then you would submit that to the Otto Bremer Foundation. And there is a site. So the foundation is different from the bank. The foundation owns the bank. and then the bank gives profits to the foundation, and the foundation uses the profits that the bank made to give grants to nonprofits in the communities that we serve in Minnesota, Wisconsin, and North Dakota.
Cool.
Thank you.
You're welcome.
Any more question for Scott or Tiffany?
Wow.
I think there was a question earlier to Tiffany about how we get into investment properties. Tiffany, I don't know if you want to come back to that in terms of the process for that too. I think a couple of people were interested into that.
Yeah, and the process is the same. So the process, it always starts with an online application that the individual will complete. So that, in a sense, is the same. The difference is I'm going to get information as part of the application that tells me what are you using the property for. So an investment, a primary residence, a second home. And then when I pull your credit, I'll also see if you already own a home. Maybe there's a mortgage there. So then that tells me how much money you as an individual would need to put down on that purchase based on your need or your use for the property. So the process itself, completing the online application, providing income and asset documents. So to give you all an idea, when you start the pre-approval process, you're going to complete an online application, may take you 5 to 10 minutes, and you're going to provide me with items that help me verify your income and your assets. So it's going to be 30 days of 30 days of pay stubs, 2 months of bank statements, and 2 years of W-2s. Individuals that are self-employed, so you're operating your own business, we determine your income using 2 years of federal tax returns. So whatever you're reporting on your tax return is the income we're going to be able to use to qualify you. So if you've written off a lot of items because you have a ton of expenses and you did that to lower your tax responsibility, understand that your bottom line income after expenses is the income that we're going to use. And in that 2-year sense, we're going to take a 2-year average. So if 1 year you made 60,000 and the next year you made 90,000, that's 150,000 over 2 years. I'm going to divide that by 2. That's $75,000 per year that you average, and then I'll divide that by 12 to get monthly income. So again, for self-employed individuals, we're looking for a 2-year average. Great question.
Awesome. Thank you.
Thank you, Tiffany. I see 3 hands here, and I will go to the order as I receive them. Madame Doué, if you can go first.
Hi, my question is for Stephanie. It's like you already have everything's done and you purchase the house and your mortgage is kind of 1,500. You borrowed, we can say 200,000, okay? At the end, how much you really pay, if it's 30 years or if it's 20 or 15, because we really don't know. I know I saw the interest was 5 point something, but how much you really pay back?
That's a great question. I can pull up a loan amortization schedule. It may take me about a minute or so, but I can pull one of those up and show it to you on the screen. One thing you want to understand is 30 years is a long time to borrow money. So most people that purchase a home, they purchase a home using a 30-year loan. So if it's taking you 30 years to pay a loan back, understand that you're going to pay a lot in interest over that 30-year time frame. I want to say, oh, I can look at my normal presentation. Just a moment. I have an example for a $171,000 purchase, like the one I pulled up, the one I showed you all on the screen, that 175 purchase. And I want to say the interest over the life of the loan was like $130,000 or something like that. I'm going to pull up my original presentation because that was one of the slides I pulled out today in the interest of time, but I will just grab that quickly so I can give that number to you again. Based on the example that I showed you all, a $175,000 purchase at 4.25% over 30 years. I'm going to pull up what that interest is over the life of the loan. It's just taking it a second to come up on my screen. So while that's coming up, do we want to go to that second question?
Um, Maxime, if you can then go and we come back to Madame Dewey.
Okay, I think Benny were before me, but my question, my last question is, we have on the call couple people do not have house yet, or are not on a mortgage yet. So what is like for Tiffany the real reason for moving from renting to mortgage? Yeah, so different kind of argument to motivate those who are like hesitating. Oh, should I keep stay on my renting, or should I definitely move to mortgage? Yeah.
Can I answer that, Tiffany?
This
Yes,
is
go ahead, Larry.
it's one on one.
What does it create? It creates generational wealth when you buy a home. That's the difference.
Yeah.
Okay? That's
It's
what
the
we find.
number one way of acquiring wealth in the country is to purchase a home. That's where you're most likely to generate your wealth from. It helps you to create a legacy for your family, and you get to build equity. When you are paying your to rent a house, you are essentially paying for someone else's home. It's part of their retirement plan, and
Yeah.
when they're ready to retire, they're going to sell that home, and that's something you could potentially do for your family and your legacy. So instead of helping to make them rich, you can help make yourself rich and have something to leave to your loved ones. I have the answer to that first question. In the example of that purchase of 175, if you all remember, the loan amount was $171,000, almost 172,000. Once you put in your down payment and added that FHA fee back, the interest rate is 4.25%, as you'll remember. Over 30 years, if you paid no extra principal and interest payment, so you just made your regular payment over a 30-year period, you will pay $132,000 in interest.
What you
Wow.
mean is kind of double
132
what
top of the
you put, what you used to buy the house.
I'm
How
sorry, I
much?
missed that question.
I said, if he's, you said it's 130, right? The interest,
132,000
132,000 is
over 30
almost
years.
for 30 years. It almost the money you use to buy the house for
Correct.
interest only. Okay, so if I decide to pay like 15 years, how much? When do I know that how much I left to pay the rest? Because I don't. You see what I mean? Like I'm
So there,
paying more
there,
every month
there
to
are loan
reduce.
amortization schedules
Uh-huh.
that you can use to help you see the impact of extra principal payments. So you could pay extra towards your mortgage every month to save
Mm-hmm.
yourself interest over the life of the loan. So as an example, in the financing example that I gave, that 171,000 for 4.25%. Actually, I'll share my screen. It may be easier for you all to see it.
Yeah,
You
it's
just
much
give me a
better.
moment. I'm just
Thank
going to
you.
share this screen and then you all can see what it looks like. So
Not
let
all of us can juggle numbers as well, Tiffany.
yes, I'll share this. Where's my screen here? And maybe screen one. It's weird because I have several screens. So if I bring that down, hold on. Yes, can you all see it?
Yes, it's
It's
coming.
yeah, it's coming.
Yep, I can see it now.
Perfect. So we have the sample purchase is the sample purchase that I had in the presentation. The loan amount, the interest rate is 30 years, and the principal and interest portion, that's the portion that goes to the bank to pay the loan back, is 845 and 30 cents. So the first box on the right is the amortization schedule. You can see how much money you will have paid in interest at the end of the first year, at the end of the fifth year, and at the end of the 30th year. That's why I said that amount is $132,478. Now, that second box at the bottom, you can see the impact of extra payments. So if you have this loan and you pay an extra $50 per month, so every month you just increase whatever your payment is by $50, the bank will automatically apply that extra $50 towards the principal of your loan. You'll save almost $16,000 over the life of the loan and shave 3 years off of your mortgage. that $50 per month equals $600 per year. Now, instead of paying $50 per month, if you're able to one time a year make an extra payment, in this example, the extra payment is whatever your principal and interest payment is. It's $845 and 30 cents. So if one time per year you make an extra principal and interest payment, you're going to save yourself $22,000 and shave 4 years off of your loan. So there are amortization schedules online. You can just Google amortization schedule or reach out to me. I'm happy to get you one as well. You can put in what the loan amount is, what the interest rate is. It'll automatically tell you your payment once you tell it what loan term. Again, most people are buying homes with 30-year loans. And then you can tell it how much you are going to pay extra per month, whether it's 50, 75, 100, and it'll show you the original amount of interest you would have paid compared to the interest that you're saving by making those principal only payments. So 30 years, you can see 132, that's a lot of money, right? But it is over 30 years. And the other thing to think about, over that 30-year period, the value of your home has appreciated. So there's still a benefit in purchasing a home. It's still a great idea, even though you're going to pay a ton of interest over 30 years if your loan is 30 years.
So
Thank you. Much
Great
better. Yeah. Thank
I
you.
want to be mindful of people time here. We have some guesses, and the time we at past 3 o'clock. If it's okay with our guesses here, I have two people wanted to ask if we can allow them to ask their question. Then we can close after that. That would be great.
Okay.
Is that okay? Okay. So Usman Yo.
All right, thank you, Ibrahim. Hey, Tiffany, I have a question for you. In this group here, we do have a lot of new immigrants. So what is the status that they have to hold in order to be able to purchase the home, which is, of course, living the American dream, right? So what status do they have to hold? And also, how long do they have to have been already in the States to be able to purchase a home, for that matter?
So generally, when I look at the type of financing we use, conventional FHA, and we're using down payment programs, you need to be at least a permanent resident alien. You do not need to be a citizen, but a permanent resident alien with the Social Security card and employment, or Social Security number and employment, you can typically qualify. There are discussions happening around I-10s, people who don't have Social Security numbers and using other things. I don't have a financing option for that capacity as of yet. But so a permanent resident alien is what we're requiring.
So someone who just have a work permit, but he's not a permanent resident yet, since he already has his work permit, maybe has it for a couple of years, would that person be able to then apply? I just want to make sure.
Nope, they would need to be a permanent resident alien. A permanent resident.
All right, thank you.
Great question.
Okay, Madam Due, so we can close with you.
Madam Libby.
Madam Libby, sorry.
Looks like she just left. Oh.
Okay.
Madam Libby, are you there?
Oh, there she is.
Yes, she is. Okay.
Can you give me 1 minute? Yes. Okay. So what I was gonna say is just the 30-year loan, it might be scary. It looks scary that, oh, I'm gonna pay a lot of money, but it's worth it. Because in my case, we bought a townhouse like I don't know, 6 years ago. We were in a townhouse. Then after that, we sold it. We got a lot of money back because the house, it can appreciate, the price. So when you sell it, you can have some money back, and then you can move to, another way that you want to do what you want to do with the money. So 30 years, it might be scary, but I think it's worth it to do it. So that's what I was going to add. Thank you.
Thank you for that. I'll second that.
Yes. I want to say I'll be the third person on that. Anyway, we are time, and I will pass it to our president to close. So Guy, if you can close.
Yeah. Thank you so much, everybody. Thank you, Tiffany. Thank you, Scott, Larry, Basil, Bernard, I know you didn't have a chance to talk, but thank you for being on the call. There's a reason why you guys were on the call because there's other discussion happening on the background, so you have a better visibility of what we're trying to do. So want to say thank you to our members as well. We do have a lot of work. After this minute here, we're going to regroup very soon. We're going to debrief this. We're going to make a couple of decisions together, and it's going to be, a very nice journey to write together. So thank you everyone for your time, and I'll see you again next month. Again, God bless you. So before I conclude this, I want to allow our pastor Max Voin to say a last prayer to close this. Thank you so much, everyone.
Merci pour cette belle rencontre que nous avons eue. Merci pour tout ce que nous avons appris. Merci pour la suite. Merci pour nos guest speakers. Merci pour chacun qui est venu et même pour ceux qui ne sont pas venus. Sois avec chacun de nous et nous te disons merci. Amen.
Amen.
Officially closed.
Thank you.
Okay.
Thank you.
Thank you, everyone.
Thank you, Tiff. Thanks, Scott.
Thank you, everyone.
I hope you all have a great day.
Thank you, Charles. Yeah, I think I'll get in touch with you again. I saw
Thank
the
you.
Independence Bank that you put in the chat, so we'll talk about that again.
Would you want me to give you one of the banker's contact information?
Well, let's debrief this first, and then we'll move forward.
All right. Bye.
The